Hello, everyone, and welcome to the EXANTE webinar. Thank you for joining us today. We're going to give another 30 seconds for other participants to join, and we'll start. So thank you for joining us today. My name is Chris Antoniewski, and I am delighted to be joined by my colleague, Dr. Rene Friedman, who will be sharing her latest market insights and updates. We aim to deliver about 30 minutes of high quality, actionable content. So I think we are having more and more people joining. So without further ado, let's get straight into it. Rene, the floor is yours, and I'll return to you after Rene's session. So stay tuned. Thank you very much, and the floor is yours, Rene.
Great. Thank you very much, Chris. And hello to everyone. Thank you for joining us today. Just starting off, I just want to share very quickly for those of you who are our clients and for those of you who aren't, just to let you know, you can sign up at exante.eu and get free market analysis. We supply our daily, weekly, monthly, and quarterly market analysis. We also have our monthly fixed income briefing, our monthly equity review during earnings season, our earnings scoreboard, and then we have our Alpha Vibes, which is a deep sectoral dive into various equities. Right, moving quickly along because it has been quite a time in markets. So in this conversation, we're going to quickly take a look at some of the regional drivers, issues around equity performance, bond market performance, currency performance, where you ought to be looking next for the second half of the year, because we're almost at the end of Q2, potential derailers, and what we consider to be 4 market truths. All right. The big one, of course, is what's been going on in the U.S. In the U.S., we know about the AI surge, right? We have about 700 billion of AI capex coming through. It's around between 640, 690, even more when we look at forward figures going into 2031, hundreds of billions more. And that is, of course, going for the AI build out in terms of data centers, semiconductors, and cloud services. It's also been a great earnings season. Q1 and Q2 is looking pretty good too, right? We've got FactSet projecting 22% EPS growth for Q2 and 23.3% for all of 2026. And at the end of the day, it's all about AI. AI adoption is driving margin expansion across all sectors. Now, the big thing, of course, is what happened last week. And this is what hit markets a bit yesterday, this concern around the increasingly hawkish Fed. Last week, of course, the Fed went on hold, but we are seeing one hike priced in. With the new chair, Kevin Warsh, it was his first meeting as chair. He did not actually give a forward projection. Other Fed policymakers did. We had a number of at least one hike put in, a number of holds, and only one potential cut coming through. So that rate trajectory is very much becoming the key market variable. That is what's really pushing the market. And we saw that on Monday, we saw that yesterday, and it's becoming very reactive to news flow. And that is one of the reasons why Warsh may be pulling back on guidance. Now, the other big thing that we're seeing is small cap rotation emerging. So U.S. manufacturing itself is actually stabilizing. That came through in the PMI figures coming out yesterday. It is in positive territory. It has been for quite a while. And that is actually quite good for smaller stocks. And in fact, the Russell 2000 is up, as of a couple of days ago, 21%. It's up about 20% now. There's a bit of a drop yesterday, but it's at around 20% year-to-date level. So we are seeing increasing movement there. Now, there are, however, a number of risks that are on the calendar. And one of the big things has been, is there an AI bubble? And that's around the valuation concentrations. So that earning growth that we saw, that 22%, it's very concentrated, that growth. And that is a bit of a concern. We're not seeing as much of a breadth within this, which is what we would like to see. And there's also this growing concern about the capex overinvestment. As I said, they're going to be looking at up to 700 billion in the next few years, even further when we look further out. But that does carry a lot of risk because it's all about what the levels of returns, the ROI will be on that. The other big thing we see pushing the US, and this is reflected in the bond markets, is fiscal deterioration. Now, longer term yields have been going up, 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 up. And in fact, the US 30-year Treasury is approaching the 5% mark. It actually was over that. It's pulled back a bit. We have seen, of course, rising structural spending within the budget. Again, there are certain things that have to be funded every year within the US. Congress has no choice around that. They have to fund, and a lot of that is demographically related. So issues related, for example, to Social Security and other social spending. There's also the fact that interest rate costs. The U.S. is paying a huge amount of interest rate costs every month. So that's pushing the debt level higher. So overall, the term premium risk is rising. The other big thing, of course, is tariff pass-through. Tariff pass-through. That actually added some degree of 0.8% of a percentage point to US CPI last time, right? So it's still passing through. It's still a bit of an issue. This is why the Fed is being so hawkish. Again, tariffs haven't gone away completely, despite that ruling earlier this year in February. Most recently, they're looking under the Trump administration to impose an additional 10 to 12.5% tariff based on countries' adherence to the use of labor, free labor in products that are supplied. And that review is up until the 6th of July. And then they're also looking at potential other things on tariffs. So we are looking at tariff rates continuing between the 10 to 15% range. The other big thing, of course, is the U.S.-Mexico-Canada agreement. Now that's up for review on starting the 1st of July. Now they can close this down, and it doesn't close down immediately. This is something that goes through to 2036. But they can then, if they decide not to review it, they will have to review it again next year and make a decision. So this will come up every year. Otherwise, if they review it this year, agree, then it's good for another 6 years before the next agreement. Okay. Now the other big thing is what's happening in Europe. Now the stocks Europe 600 is also looking positive, some positive territory, but only at 12%. Europe is in a much different growth dynamic than the US. And again, a lot of it has to do with the fact that inflation has been rising there. It's been very high in the US as well. It's been above that 2% rate for 2% target rate for quite a long period. Neither central bank has been able to reach that. But we are looking at about 31 bips been priced in thus far, that mark, for further rate rises this year. So we are looking at another rate rise. We had one earlier this month, but the ECB is being very cautious about this. They're waiting to see what happens with the situation, of course, in Iran, whether or not that peace deal holds. Now, one of the big things that will push growth in Europe is this Europe 2030 readiness plan. And a lot of that is around defense spending and, of course, infrastructure build out. Particularly, Germany has done quite a bit around that, passing the bill last year to do that. However, we are seeing some issues still within Europe. Growth is slowing. Confidence has been declining. Inflation has remained sticky. Households and businesses have been having to navigate this energy price shock, not only from what's happened with the war with Iran, but of course still having to deal with the situation following on from the Ukrainian war, which is still ongoing. So the big risk for investors when we think about Europe is really around currency exposure, right? So I'll get into hedging more in a bit. Now, so the number of tailwinds, Europe still has very resilient labor markets, AI, and it's the AI productivity beneficiary. We have that defense and infrastructure fiscal multiplier in play. Valuations are actually really quite attractive in Europe. The forward PE discounts around 29%, 29.1, 29.2%. And earnings operating leverage as a revenue is accelerating. However, manufacturing sector remains soft, particularly in Germany, and that is the powerhouse of Europe. Rising inflation does mean the ECB raising rates at least once, possibly twice. They're staying on the fence a little bit about this. ECB President Christine Lagarde came out earlier this week saying, we're going to see what happens with Iran. We think it will pass through quickly. Okay, and the other big issue that we have is, of course, that there are delays in fiscal spending. Political fragmentation risk does exist in the EU. And of course, there is the point that Europe isn't growing the way the US is, not just economically, but also in terms of those hyperscalers. It doesn't have them. It doesn't have AI related capex in terms of the multiplier effect of those. And it also has energy constraints. Okay. So at the end of the day, central banks, as we've seen, have gone from very beginning of the year, everyone was expecting rate cuts. Well, guess what? Now we're all hawkish. So the Fed is on hold. One rate rise, as I said, is priced in. And we did see Kevin Moore scrap that forward guidance. That had been a big thing under the previous chair, Jerome Powell, but he has scrapped that. He's going back more to the Volcker days. He's trying to be very quiet about what they're going to do next because the market is so incredibly volatile. Yeah, but he is very much focused on inflation. So the fact that he did not, immediately advocate a rate cut, which is what President Trump wants, shows that he might be his own person on these things. As I said, the ECB is tightening at least once more, and the Bank of Japan, of course, is in a tightening cycle. We are expecting 2 more hikes, 2020 by the end of this year. And as you can see in terms of performance, we had a big drop down, of course, in May of bond performance. And a lot of that had to do around where we're seeing movements in ceasefire, non-ceasefire, with the war with Iran. Okay. The other big thing, of course, is currency performance. And again, the dollar has been very strong. We were expecting a weaker dollar at the beginning of the year, longer term weakness because of the high level of debt. However, the dollar has been very, very strong this year. A lot of that has been safe haven demand. And we've had this hawkish Fed and surprisingly resilient growth. Those job numbers a couple of weeks ago at 172,000, that non-farm payroll really surprised the market. So we're seeing some good numbers coming through in the US. In Europe, as I mentioned, we have those dovish comments from the ECB, and of course, a weaker growth trajectory. And the yen is not doing well because of those interest rate differentials. The interventions very ineffective if they tried to come in out. And of course, we're seeing a lot of foreign equity hedging taking place, which is also influencing the currency. And again, Japan does have a historically high debt level. Now, normally that would not have been as much of an issue. It's becoming more of an issue because of the demographic challenges in Japan. And of course, in the UK, which has just lost its prime minister or in the transition of, it is being hit by that strong dollar. Those, as I said, those domestic political issues. It has a very sluggish economy. The UK is probably in the worst position of all. We're looking at very high stagflation risk. And therefore, we're looking at high inflation, low growth. What does Bank of England do next? That's why they held last week. Okay. Equities performance. Again, Q1 brilliant in the US. We had a very positive beat. We've got that AI boom. And of course, for the US, they have that energy independence, right? In fact, the US is a major exporter of energy. And since the war with Iran, it's been exporting like crazy. And one of the other potential positive things for the US, it's a bit mixed, is that K-shaped spending, which means people at the top of the K are the higher income levels are supporting, and that is trickling down a little bit and supporting the economy. But more importantly, we see those resilient job numbers coming through. In Europe, again, those attractive valuations, remember trading at a 29% discount to US. It has a much broader sector mix, and it's got strong earnings coming through. In Japan, as well as in Korea, when we look at what's happening within Asia, they've got strong corporate earnings. We've had that corporate reform measures coming through. And of course, that exposure to the AI boom and reflation that we've been seeing is also helping picking up domestic demand a little bit. In the UK, the FTSE's actually performed fairly well considering the state of the UK economy. It's got attractive valuations. Its old economy stocks have actually worked to its benefit. The mining, the banks, et cetera, have all worked to its benefit. It doesn't have the AI. It has those old economy stocks. It also is very outward looking. 75% of the companies in the FTSE 100 have a global outlook in terms of their operations. So they're getting in that global revenue and also high cash returns. So let's think about where to look quickly in second half of this year. The US, well, it's about that AI point, but you have to look at where you want to invest. Choose the layer of the AI build out to own and think about the pricing of that. It's not just going in for the big chip makers. Look to the things underneath, not just to the energy providers, but all the other bits along that supply chain. Within the EU, again, we're looking, because of that bill coming through, we know we're increased spending because of NATO members. They're going to need to increase their spending. So aerospace, defense, construction, utilities, particularly utilities, given the issues around energy, development of renewables, etc. Those are looking pretty good. In Japan and Korea, again, it's those corporate governance reforms. Yes, the KOSPI was down this week, but, we do see those reforms coming through. So that should help in getting a lot of shareholder returns via buybacks, M&A, and dividends. Other points to consider is that, again, small and mid-cap rotation. We see that, as I said, that stabilization in U.S. manufacturing. And again, of course, from the big, beautiful bill from last year, which is coming to effect, that fiscal impulse coming through. So that should be positive for those smaller to medium-sized stocks. In the EU, much is going to depend upon what happens with the ECB and how their perception of inflation, whether that is unanchored or not. And they're saying at this point, it's still anchored. So what we're seeing in the near term, at least, is that banks will be the best beneficiary of that higher rates. Now, the big thing, of course, we want everyone to be thinking about is hedging currency exposure. The euro and the yen are weakening versus the US dollar because of their weaker growth dynamics and because of the inflation expectations. They're in very different positions. And a lot of that has to do with energy. Both are energy importers. Okay. So what could derail everything coming through? Well, of course, there's the point of AI overinvestment risk. If that return on investment disappoints, and again, we're seeing a lot of AI hyperscalers now going into the bond markets, and that's pushing up those bond curves at the longer end. Okay. Coming through. So if that return on investment disappoints, those tech multiples that we've been seeing growing, they're going to face that very sharp compression coming through. The other big thing that we're worried about is, of course, the China supply shock. Now, we have this issue around rare earth restrictions from China. This is still hasn't gone away. This is still going back and forth between Europe and China, as well as the US and China. So that is hitting global supply chains. The other big thing that we see a high risk of course, is around US fiscal sustainability. We do have that rising debt burden. We have higher interest costs, and that's eroding that safe haven premium at the end of the day. And that will, in the longer term, potentially weaken the dollar as well. But that's more of a medium to longer term issue. But we are looking at that point of rising debt within the US. Another big issue, of course, that we see as a medium-term risk is geopolitical escalation. There are a lot of questions around that ceasefire. When you look at the deal and the part of that ceasefire, that agreement in terms of particularly around being able to trade oil during the 60 days, it's where that goes to. What the government says and what's actually written on the paper are very different. And of course, there are a lot of issues around the toll or not to toll. And the U.S. is saying tolls will not be allowed. And that's, of course, from a political standpoint, that would show that Trump was very weak, which he doesn't want to show, at least particularly in the run up to a midterm election. He has to show that he got something out of this beyond just the closure of Iran's nuclear program. So the big risk is the ceasefire doesn't fall, and that Hormuz, which is temporarily opening, we've seen a few more boats coming through, actually doesn't. And still, it's going to take a lot of time to get everything back online. So markets need to keep that in mind. They're being perhaps a bit too optimistic about the timeline. We still have, of course, Ukraine, Russia war going on. And again, China, US, and even European trade retaliations taking place. That agreement with China that the US signed last November expires this November. So we have to keep that in mind. The other big thing that we see coming through is, of course, the currency carry unwind. This could easily happen. Right now, the carry trade versus EM, emerging markets, Latin America, in particular, they're at 2-year highs. But if we see a sharp reversal in the yen, that's going to trigger a rapid unwind. And that will really disturb the market, given the level of holdings by the Japanese. So the other big thing, of course, although we see a low to medium risk on this, is really about European political fragmentation, those political gridlock, delaying that fiscal spending, which Europe really needs. Now, I'm going to finish up here with 4 big truths about markets right now. Earnings are the new rate story in many ways. I mentioned that interest rates very volatile, moves the market quite a bit. But at the end of the day, when we look at what's happening with earnings season, as long as we're getting expectations, which are ever rising, of particularly in the AI sector, of delivery and upbeat forward guidance, we're going to see that will help drive returns. AI, of course, is real. This isn't, as you've probably heard this a million and one times, but this isn't, 2001. These are solid companies. But the issue is that it's not evenly distributed. The US is the AI epicenter. Europe lags in capex for AI. It is starting to capture, though, those productivity gains. And of course, we see that in Asia. Currency risk is an existential point for global investors. Given these geopolitical tensions, given these volatile oil prices, and this shifting monetary policies. Remember, there was a very different view at the beginning of the year. Really, hedge. That's all I can say. And finally, diversification is a requirement for success. Look across regions and asset classes. There's a lot of opportunities out there. There's a lot of growth going on. So don't be confined to just one region, one asset class. And particularly whether, that 60-40 portfolio is gone. There are a lot of different assets out there. Take a look across. So, for the second half of this year, we'll move from an energy supply to a relief phase if that Iran peace holds. And that's a very big if. The returns will be driven by earnings delivery, not multiple expansion. Okay, so we're maturing in that sense, but it's against the thinnest breadth of that market in years, and that's that concentration point. And that is it for me. Again, if you'd like to sign up to any of our free content products, market analysis products, you can do so at exante.eu. You can feel free to email me if you'd like this presentation or contact your client manager. Thank you. And over to you, Chris, and people can see how they can use some of this information in their portfolios.
Thank you so much, Renee. Pleasure and great to always have you and listen to your insights and market updates. Later, we'll also introduce how you can subscribe to Renee's frequent market insights and updates, which he delivers through multiple channels. So stay tuned. I will let you know how's that going later. If I may just ask you, Renee, to take over the screen, this would be great. So welcome again, everyone, and thank you for staying. Just as a reminder, in order to, and as well to score a good point with our compliance, that any market commentaries, forecasts, or views are expressed by us, are our personal opinion and should not be relied on to make your investment decisions, of course, and that the content is presented typically to professional and eligible counterparties and should not constitute any investment advice. So just keep that in mind. So what I'll do now, I'll switch on quickly to a different screen where I'll do a presentation for you of the technology and some of the options that we have available. So typically as a wealth manager in today's volatile market, you might face a compounding restrictions and problems where the portfolios are fracturing across multiple custodians, accounts, and other restrictions. So if your execution or your rebalancing workflow requires jumping between screens, jumping between custodians, manual spreadsheets, or account by account trades, you of course not only lose time, but you are also exposing your operations to a certain degree of risk. So in the next 10 to 15 minutes, we're going to look at how to compress some of the information and modules which are available on the EXANTE ATP platform, the one you download and install. And we look into how the multi-account execution workflow works well in a single seamless action. So now, Brenda mentioned all about different sectors which might be affected. So, obviously, on the EXANTE ATP platform, we have our own Omni screener where you can search and you can screen the markets for stocks, ETFs, bonds, among other products to suit your strategy. If, for example, you have your own models and strategy already, then that's great. If not, I thought I was going to mention this to you over here. So in this session, I will assume a role of a wealth manager, portfolio manager who have 5 accounts under the management. So the total is approximately 3.8 million. It does not matter. It's a demonstration mode, so it's just for purely these purposes. So let's assume that I have my own strategy. I have my own certain securities that I wish to trade. What I'll introduce now is the first module called MAT, Multi-account Trader module, where I am able to send some security and build and build. One second, and I can build certain. Not available. Just needs a moment. How about this one? Okay, so let's say I wish to execute trades on this ticket on Google, right? And I can build it across several multi-accounts. So I'm going to put into Google. Okay, I can select multiple accounts into this single strategy. So I am able to see all of them. The system will indicate the total portfolio across the simple pivot table. And I can have multiple options that I can select for the system to do. Okay, so for example, I can set a different order types, order durations, and differently split the shares. For instance, I wish to purchase 100 shares, and I can as well indicate, for example, a percentage of NAV, total NAV for the execution. So obviously, the market is at the moment on the pre-market. So perhaps I can do a limit order where I can indicate the current price to buy. Ask is 348, bid 347. So I can perhaps enter at the price of 350 if I wish to execute that across multiple accounts. The pivot table indicates the fees, indicates the quantities, etc. So I am able then to place such orders. Okay, so limit day buy order will be pending. I can execute it perhaps, and if of course I would enter some kind of a closer price and there would be liquidity in the pre-market, the order will be executed. I can see the order was filled and executed. Okay, so I can see that across these sub accounts 4, 5, 6, 7, 8. I have executed the buy order on this ticker. So this using a very seamless action. I was able to execute the trade of those. The total was 547. There are obviously different allocation methods. You can choose equally by the number of shares that you wish to purchase given any portfolio. If there are more sub accounts to which I would have access, I can add them, or I can almost have unlimited number of sub accounts, which would represent then a different portfolio, right? So I can go and see this reflection in each of the accounts. So this is my total for this portfolio of 5 accounts. I can go to each and every one of them and see the position, the quantity. I see at which price I bought, the current price, so on and so forth. So that gives me a clear visibility. I can, of course, go and now close some trades. I can close or go to the sell options for different, again, orders and durations. I can go into portfolio and select and do all the trades. So this is a very seamless action. I can, for instance, let's go into another one. Let's go into some market which is open right now. It's not in pre-market. Let's go into some ETFs. Obviously, the market data is delayed by 30 minutes on demonstration modes. That's why you'll see some of the other prices. So I'm going to the Vanguard ETF, which is traded on the LSE. And again, I can place a certain orders depending on how much I wish to buy, how many shares I wish to buy in this instrument, and the system will indicate the quantity, will indicate, so you are always informed of what you do. So if I can go market order, and again, the system filled a order across all 4 sub accounts for this ticker, and I can do reversal, and the system will sell it. Then I can obviously see the trades and transactions history available in the trade blotter. Again, it's a pivot table which gives you a first trade and transaction data. Through the platform is very simple. You can obviously get a proper reporting via the client's area and administration tools. So this is the very first module. MAT is a single, powerful, simple, basic but powerful tool which allows you to trade any of the securities available. And some of you may know, if not, we have access to EXANTE to more than 1.5 million instruments across multiple asset classes. Let's move on to a second module, which we have, which is a little bit more advanced. It is a little bit more towards execution across multiple accounts and towards rebalancing of portfolios. So I will introduce to this as just let's create a testing allocation. So I will create a first model. I will call it. I always like to call it a. Let's go for this one. I need to drag an instrument. So let me go back into my watch list. I'm going to put it here. And I'll go into some of the US markets. I'm going to drag my setup. I'll drag my stocks that I wish to put as an asset model. I would like to prepare. And across this model, I want all of those instruments to go into 100%. So let's say let's say model that 50% would go towards Apple, 25 Amazon, and 25 Google. So I'm going to go save model. I'm going to go into account set, and I can select again different accounts. As long as I have access, trading access to them, I'm able to select them. And the system is giving some options for investment percentage. So maybe I wish to allocate 10% in this account, or use the 10% of the available money here, 20% here, 5, 5, and 5. I'm going to save the account set, save model. And when it comes to the order placement, I am able to select some of continue with positions. Let's go for this card. I had some positions. So I can right now the market is free. So let me go into, let's say 293. I'm going to go 233 and 347. So okay. Limit date maybe I already have some trades on Google. If not, I'll investigate why. So the system would indicate why, and the system will indicate more or less the split between the accounts. Okay, so once you create the orders or press to create the orders, the system will indicate how many you would buy, how many you would say. So how many. And what's the position before, what's the position after, confirm, and the system will indicate and will the updates, okay, and the system would create the pending orders, which I will be able to see in it has not. let's do it again. So I'm going to go into the allocator. One moment. Let's create a new one. Let's create a new one where I'll go, for example, let's go for Euro USD. I want to, let's say, for example, go into Euro USD setup here. And then Euro USD, and I'll go as well for Euro versus Pound, for example. And now I am able to select the account set. Again, I want the quantity instead of quantity. I'm going for the percentage. I want Euro USD to make up 75%, and then 25% will be Euro versus Pound. Account set. Let me save this one. I'm going to account set. Again, the same account set, more or less the same investment percentage. Order placement, save model, new model, and account set. Invalid placing error. Okay. Now that has not worked as expected. However, account set, let me redo the account set again. I'll remove one of the accounts, close positions, and I'll go to new model one, account set. I'll go into a new one. Let's say I'm going to go on those three accounts here. Set one, investment percentage, let's say 10% here, 10% of free equity here, 10% free of equity here. Save model. Okay, so now I'll go into, I can switch between the order types, and the system will indicate how much of the, based on the free money on all of the accounts and based on the asset module, I am able to create the orders. The system is indicating that across all of those free sub accounts, I will be able to open, this will be the position after. I will confirm. Okay, so the system has executed the trades. I am able to see this. Is it updated today? Yeah, sure. Okay. The system has perhaps needs a little bit of time. Select. Aha. Okay. So the system have executed here this model, model number one, and just a moment. Just make sure everything is still working well. Okay, so so let's say that after some time, I wish to edit this, and I wish to rebalance the position on those in this model. So I would like that the target will be that it will be now 50-50, the target percentage between on euro dollar and euro British pounds. I'll go save model, and I can go. I can proceed to rebalance all orders. Markets. So the system will indicate that in order to properly rebalance the orders on this sub accounts, on these three sub accounts, euro dollar, we will close 25% volume on this one, 25,000 across those few accounts, and euro pound will be the position euro pound will be increased. So I can go to create orders, and the system will indicate the positions before across those sub accounts and across those instruments, and what will be after. If I go to confirm, the system will execute the trade, and I'll be able to see this in order window, and I'll be able to see then which positions have been closed, which positions have been ordered. And so when I go back into the entire portfolio, I'll be able to see my positions across the different instruments. So on this sub account, I'll be holding certain volume, so on and so forth. So this is a little bit more advanced module, which you can as well have access to. Now, I think we are sort of coming towards the time now. So to respect your time, we are at about 20-minute mark, at around 20-minute mark for this session. So what I can propose now that if you would like to see how the multi-account trader and the allocator module execution can be integrated with your technology, with your stack of custodians, of course, contact your assigned relationship manager for a brief consultation. And if you do not have one assigned yet, no problem. You will shortly receive an email containing this webinar recording, and a dedicated relationship manager will reach out to introduce themselves, offer support, provide any additional information you may require regarding this topic or EXANTE technology and services more broadly. And of course, information including subscription to René's frequent market insights and updates. So I think from this spot, thank you very much for your time today, and let's sharpen those execution workflows. Have a great day, and please let us know if you have questions.